Here is a cycle of emotion that you probably recognize something from yourself, because this cycle really just tells you that a lot of people buy just on the way up, and in extreme optimism is when everybody gets into the market. When you first sell off, you say, oh, it's just a temporary sell-off, don't worry about it. Then you say, wait for the rally to sell, and then don't wait for any rally more, and most people sell at the bottom. Before the cycle turns back up again, where you say, oh, well, now don't mind, it's another rally, and then the cycle repeats itself. That is what we call the 200-day moving average. And if you do nothing else but have a look at the chart and have a look at where it is the 200-day moving average, because invariably the stock needs to break out before it gets on the up leg, and the stock usually breaks down before the beginning of a down leg. And so if you can catch the bottom here as the stock makes a base and then eventually breaks out, crossing the 200-day moving average, which itself is now going to turn, then you are buying something extremely positive. And if you can catch this point here, where the 200-day moving average is starting to turn down and the price starting to come below the 200-day moving average, then you can catch something and get out of something which is now probably not very good. There are three cycles that we look at very studiously. One of them is the 21-day, the 70-day, and the 39-week cycle. One of the most interesting things that is about to happen is that the 70-day cycle and the 39-week cycle are going to bottom, or at least come to maturity, or likely to hit a low sometimes on the 19th of December. Obviously, don't call me on the 20th of December and say, well, hey, like what happened? It is plus and minus days or maybe even weeks. But the fact that these two cycles coincide could be very interesting in the terms of that may be the culmination of the current sell-off. So I would certainly be looking at about mid-December to say if the negativism has come to an extreme. Really want to pay attention to is what we call a 200-day or 40 weeks, which is what the red line is. And as you can see, if this is the picture of the S&P 500, the U.S. market, and the 200-day moving average was rising, and everything was fine, as I said. Just wait till it turns down. It turned down over here. The price break below it. Very often there is a rally right to the falling 200-day moving average, which, if you haven't got out before, this would be your best selling opportunity, and you know where the market is right now. Hello. Is that when you're putting in a stop loss, never put the stop loss the round number, because the specialists love to take your stock away at a round number. If you have a stop loss and you put it in at, let's say, $10, invariably the stock will sell down to that $10 and the specialist will buy it from you and trigger it, and then the stock turns around. So I always put my stop losses about 10, 15, 20 cents below the round number, and that seemed to work better than the specialists don't come down and eat the stock away from you. I hope that I'm not sure, I hope you understand what I'm saying.